Hey everybody, it's your old pal Brian Hunt. Welcome to another episode of 60 Seconds of Risk. Today we're going to talk about a concept that you might have heard of, but you're not quite sure as it respects to insurance and whether or not how much money you pay each year, and that's called captives. Now, what captives are in a nutshell are smaller, self-created insurance companies that allows individuals or firms specifically to retain a lot of that risk and really remove themselves from the full insurance spectrum of the insurance markets. Because a lot of you probably know, if you're responsible for procuring the insurance at your firm, rates have been going up pretty steadily for the past 5-7 years for a number of reasons, because of severity of claims occurring as a result of climate change, from flooding and high wind storms, to severity of auto accidents, commercial auto accidents, that claims get bigger and bigger and then piercing through the umbrella into the excess tower, which we'll talk about that in another episode. And whether umbrella rates are higher, cyber, D&O, there's a lot of upward pressure on rates. So the question sometimes people ask is, what can they do to insulate themselves from the pressure of the overall insurance market, or what can they do to save some money on insurance? And that's where captives come in. But let's step back for a second, and let's sort of use an analogy in the sense that, let's think this M&M is your firm, and for the purpose of this conversation, it's a general contractor, and you pay your insurance like everybody else on an annual basis, and you get lumped in into the entire insurance marketplace. And regardless whether or not you've got great loss history, not many losses, not many claims, the numbers and severity are pretty small, and you got a modifier less than 1, but you're still seeing upward pressure across your rates, and you're thinking, doesn't seem fair. I'm doing a good job at keeping my claims intact, not having a lot of losses. I put a lot of money and effort into health and safety at my firm. Why do I keep on getting these claims? And the pure fact of the matter is that you're just in lump sum with the rest of the market, that maybe your rate increases aren't as bad compared to everybody else, but you're still seeing rate increases. So that's where alternative risk financing comes into play, where you're trying to find ways to reduce your overall spend. Because let's say, for the purpose of this conversation, you get lumped into your policies with the rest of the marketplace, and you're that general contractor, and every year you pay, for the purpose of this, $1 million in premium on an annualized basis. So I've got 10 $20 bills, so let's assume each one of these is $100,000. So each year you're spending out $1 million every year in guaranteed cost insurance. Now you want to say, hey, I want to try to reduce that spend. What can I do? Well, what you typically do is retain most of that risk, and maybe have a rather smaller deductible, say $5,000 or $10,000. You up it to $250,000, become a high deductible policy, but still here. That can help. But that's sort of the next step. If you're going to go high deductible, then that's typically where the concept of group captive comes into play. In the sense that, you know what, rather than me being that one general contractor in this big old barrel full of other entities, let's see if there's a final way I can go to a smaller insurance firm or insurance company, and therefore retain a lot of that risk. And that's typically what a group captive is about. So as you think about these are smaller than that bigger jar, and you've got a smaller number of firms in each one of these. So these are two types of group captives. The ones with the different colors represents what's called a heterogeneous group captive, which means there are multiple types of industries and maybe geographic diversification as far as where the risk is. So rather than being maybe the general contractor in there, but you're lumped in there with auto dealerships or healthcare, pharmaceuticals, hospitals, entertainment facilities, universities. So it's kind of a big mix. And there's pros to cons to that as far as having diversification of the risk and the portfolio of this group captive. But at the same time, you're lumped in with a bunch of industries that they don't know construction, the risk control specialists don't understand construction, the job sites, they're covering types of different industries, may not be a good fit. So in essence, another option for you is to go into homogeneous group captive, which all of these represents everyone here is a general contractor. So you've got a bunch of peers who think like you, talk like you, think about risk in construction the same way. You're sharing risk consultants who know and concentrate on construction. Now, obviously, you're all in the same industry, so from a systematic approach, you're exposed to downturns in the market like anybody else. But if heavy construction goes down, you're definitely going to feel it. But the flip side, you might have a different geographic spread across the country. It's like places like Texas are doing well, maybe something like Massachusetts doesn't do as well, you still have diversification of risk. But in this situation, in either sort of those group captives, you're probably going to spend less each year on the actual cost of insurance. Now, rather than this situation being $1 million guaranteed up front, you're going to spend maybe, like, say, for the purpose of this conversation, $500,000. So each year you're going to spend $500,000 on the insurance as part of the group captive. That's a higher deductible. Then this typically is $250,000, which means for every claim that occurs, you are going to pay for the first $250,000. Now, if everything goes right, like you had low claims loss history, and you keep your health and safety team intact, and the culture still exists, you're hoping is that you're going to have less claims overall. Maybe you got to pay the first $200,000 of claims, and then you're also paying maybe some additional $100,000 in fees, but also you're going to probably pay for actuarial studies, but also maybe pay for improving the health and safety team at your company, maybe hire some more people, really sort of invest in your firm to make it more resilient from a loss perspective. And if you do it right, maybe in that first year or every year going forward, you're going to have $200,000 in excess sitting there that you typically had to spend in the insurance company, but now you've got it sitting in your reserves. And let's assume everything goes well, and for the next 5 years, you get $200,000 sitting in reserve every time. So now you've built up $1 million in reserves. Now, odds are you're probably not going to do that well. You might have some bad years along the way, maybe a really bad claim. But if you do it properly, you got, say, $700,000 sitting in reserves after 5 years, which you would not have had if you stayed in the guaranteed cost. And the great thing about the group captive is that this is your assets, and they can let it ride and grow. And as it grows and gets bigger, as your company gets bigger, you have the ability to retain more risk and really are insulating yourselves from the winds of the insurance marketplace. Now, also might happen as your firm gets bigger and bigger, you might say, you know what, this has been great. When I first started, I don't want to be a group captive. I want to have my own captive. So what that happens means as you start your own firm. It is a sole captive. You own it. This is your firm. You pass everything you have, you typically have, through it. You transfer the monies into it. Congratulations. Now, actually, my old firm, I used to work for a large general contractor here in Dallas, and they have their own sole captive as well. And it can be a very powerful tool. But I tell people when they go down this route as far as group captives or captives, first, you better really take your health and safety seriously, because you are retaining a lot more of that risk. So you're betting on you and your team to establish a community and a sense of health and safety that permeates throughout the entire organization. Because in a large deductible, you're going to eat that first $250,000 of a claim. So take it seriously. Now, especially going to group captives, it's not for the lighthearted. And I tell people, it's like going in the mob. Once you go in, it's really hard to get out. Because once you go in, you got to post collateral. And if you leave, you got to leave money aside to burn off your claims that the group captive is going to retain. And that could be a multi-year stage process to go from a group captive to your own captive. So it's kind of like the evolution and maturity of your firm. When you start off, you're going guaranteed cost, and then eventually maybe you go to group captive to the point you finally actually have your own captive. So that's been group captives and captives in a nutshell. Hope you found this very informative. Like always, if you find a topic here you'd like me to cover or a person you want me to interview, please let me know on LinkedIn. Leave a post or send me a message. As always, you can subscribe to my channel on YouTube to find these videos, and you can also find the links to these videos as well on my YouTube. My Twitter. Until next time, guys, take care.